For decades, the American credit card represented something much bigger than a piece of plastic. It represented freedom, freedom to travel, freedom to buy a home, freedom to furnish an apartment, pay for emergencies, take a vacation, or simply make it to the next paycheck. Banks promoted it as a symbol of financial success, and millions of Americans accepted the offer believing they were gaining flexibility. But today, that same piece of plastic has quietly become one of the most dangerous financial traps in the country. Right now, across the United States, millions of people wake up every morning carrying debt that follows them everywhere they go. They carry it to work, they carry it to the grocery store, they carry it while paying rent, filling their gas tank, buying medicine, and even while trying to enjoy a weekend with their families. It never disappears, it only grows. The frightening part is that many of these people are not unemployed. They are not reckless spenders. They are teachers, nurses, truck drivers, police officers, office workers, engineers, and small business owners. They have jobs. Some even earn six-figure salaries. Yet, despite working harder than ever before, they find themselves trapped inside a financial system that becomes harder to escape every single month. For years, Americans were told that responsible borrowing could help build wealth. Credit cards promised cashback rewards, travel points, airline miles, and exclusive benefits. Television commercials showed smiling families enjoying expensive vacations, luxury shopping trips, and beautiful restaurants, all paid for with a simple swipe. But those advertisements rarely showed what happened months later. They never showed the anxiety of opening a monthly statement. They never showed someone staring at a balance that somehow kept increasing despite making payments every month. They never showed parents lying awake at night wondering how they would afford groceries after paying their minimum credit card bill. Today, America faces a credit card debt crisis unlike anything seen before. Household debt has climbed to record levels, while high interest rates have made borrowing dramatically more expensive. What once felt manageable has become overwhelming for millions of families. Imagine this. A young couple finally moves into their first apartment. They need furniture, a refrigerator, kitchen supplies, a washing machine, and basic household items. They don't have enough savings, so they put everything on credit cards. At first, it feels harmless. They promise themselves they'll pay everything off within a few months. Then the car breaks down. A medical emergency arrives. Rent increases. Food becomes more expensive. Insurance premiums rise. Suddenly, instead of paying off the balance, they're only making the minimum payment every month. Months turn into years. The balance barely changes. Interest keeps growing. Before they realize it, thousands of dollars have disappeared, not because they bought new things, but because they're paying interest on money they borrowed years ago. This story isn't unusual anymore. It's becoming the new normal. America has experienced periods of financial uncertainty before. The Great Depression destroyed fortunes and forced millions into poverty. The 2008 financial crisis wiped out home values, retirement savings, and jobs across the nation. But today's credit card crisis is different. It isn't concentrated inside banks alone. It exists inside ordinary American households. Instead of toxic mortgages sitting on financial institutions' balance sheets, today's financial pressure lives inside family kitchens, wallets, and monthly budgets. Every swipe of a credit card may seem small: $20, $50, $100. Individually, these purchases appear harmless. Together, they create mountains of debt that become increasingly difficult to escape. Modern life has quietly become more expensive in nearly every direction. Housing costs continue climbing. Healthcare bills remain unpredictable. College tuition has increased dramatically over the past few decades. Car insurance costs have risen. Utilities consume larger portions of household income. Even something as simple as buying groceries costs noticeably more than it did only a few years ago. Meanwhile, many workers feel their paychecks simply aren't keeping up. When income struggles to match expenses, something has to fill the gap. For millions of Americans, that gap has become credit cards. The dangerous part is that debt doesn't grow in a straight line. Interest creates a snowball effect. The longer balances remain unpaid, the faster they expand. Many cardholders believe making the minimum payment means they're managing their finances responsibly. In reality, minimum payments often keep borrowers trapped for years, while banks continue collecting interest month after month. It's a cycle designed to feel manageable. Arguments over money become more common. Sleep becomes difficult. Mental health suffers. Parents begin hiding financial problems from their children. Couples avoid discussing bills because every conversation turns into another argument. Some people even avoid answering phone calls, fearing debt collectors or unknown numbers. Money problems slowly transform into emotional problems, and emotional problems eventually become health problems. This is why economists pay close attention to household debt. Because when millions of families struggle simultaneously, the effects spread throughout the economy. Consumers spend less, businesses sell fewer products, companies reduce hiring, economic growth slows, confidence disappears. What begins as individual financial stress can eventually affect an entire nation. Yet perhaps the most surprising reality is that many Americans don't recognize how serious the situation has become. Debt has become normalized. Car loans are normal, student loans are normal, mortgages are normal, credit card balances are normal. Buy now, pay later services are normal. Monthly payments have become so common that many people no longer ask how much something actually costs. Instead, they ask only one question: what's the monthly payment? That simple change in thinking has quietly reshaped American consumer culture. Instead of buying what people can afford today, many buy what they hope they'll be able to afford tomorrow. Sometimes that future never arrives. Unexpected layoffs happen, medical emergencies occur, inflation rises, interest rates increase. Suddenly, carefully balanced budgets collapse almost overnight. The financial cushion many families believed they had simply disappears. The truth is that America's credit card crisis didn't appear overnight. It wasn't caused by one bad decision. It wasn't created by one recession. It wasn't the result of one government policy. Instead, it developed slowly over decades through rising living costs, easy access to borrowing, aggressive marketing, changing consumer habits, and an economy where millions increasingly rely on debt just to maintain an ordinary lifestyle. And that raises one uncomfortable question. If millions of Americans are relying on borrowed money just to survive, what happens when they can no longer borrow? That question may determine the future of the American economy, because history has shown something important. Financial crises rarely begin with dramatic headlines. They begin quietly. One missed payment, one family under pressure, one growing balance, then another and another. Until suddenly what looked like isolated personal problems become a national crisis that nobody can ignore. If you asked someone in America 50 years ago how they paid for most of their purchases, the answer would have been simple. They used cash. If they couldn't afford something, they waited. Families saved money for months, sometimes years, before buying a new television, a washing machine, or a family vacation. Living within your means wasn't considered old-fashioned. It was considered responsible. Somewhere along the way, that mindset changed. Today, millions of Americans no longer ask, "Can I afford this?" Instead, they ask, "Can I make the monthly payment?" That subtle shift transformed not only household finances but the entire American economy. Credit cards didn't become popular by accident. Banks realized something incredibly powerful. If people paid with cash, the transaction ended immediately. But if people paid with borrowed money, the relationship between the customer and the bank could continue for years. Every unpaid balance became a source of long-term profit. So banks began competing for customers like never before. Mailboxes across America filled with pre-approved credit cards, more online shopping. Every improvement feels small by itself. Together, they create a lifestyle that becomes increasingly expensive to maintain. When unexpected expenses arrive, credit cards become the easiest solution. The problem is that emergencies rarely happen one at a time. Imagine an ordinary American family. Their child needs emergency dental work. The air conditioner stops working during the hottest week of summer. A tire blows out on the highway. Insurance deductibles suddenly become due. At the same time, grocery prices continue rising. None of these expenses feel optional. None of them can easily be delayed. Without enough emergency savings, many families reach for the same solution, the credit card. One swipe becomes five, five become 20. Within months, balances begin climbing faster than incomes. This isn't because people suddenly became irresponsible. It's because modern life has become increasingly unpredictable and expensive. For decades, wages in many industries struggled to keep pace with rising costs. Housing became less affordable. Healthcare remained one of the biggest financial risks facing American families. Childcare costs reached levels that shocked young parents. Higher education became significantly more expensive than previous generations experienced. Meanwhile, the credit card remained available. It offered immediate relief. No lengthy loan application, no waiting period. Just one tap, one swipe, and the problem seemed solved, at least for today. Banks understood human psychology remarkably well. Research consistently shows that people spend more when they use credit cards instead of cash. Swiping a card creates less emotional discomfort than handing over physical money. Digital payments make purchases feel almost invisible. That's why shopping has never been easier. One click, one fingerprint, one saved payment method. Packages arrive days later. The bill arrives weeks later. The emotional distance between buying and paying has never been greater. This system benefits businesses too. Retailers want consumers spending more. Banks want customers borrowing more. Advertising encourages people to desire more. Together, these forces create an economy heavily dependent on consumer spending, and consumer spending increasingly depends on borrowing. Then came online shopping. Suddenly, Americans no longer needed to drive to a store. Shopping became available 24 hours a day. Algorithms learned individual preferences. Advertisements followed people across websites and social media. Every scroll became another opportunity to spend. Every notification became another temptation. Limited time offers, flash sales, exclusive discounts. Buy one, get one free. Psychological triggers designed to encourage immediate decisions before rational thinking could take over. For someone already struggling financially, these marketing techniques can become incredibly difficult to resist, especially after a stressful day, especially when shopping provides temporary emotional relief. Financial experts sometimes refer to this as emotional spending. People don't always buy things because they need them. Sometimes they buy because they're stressed, lonely, anxious, celebrating, or simply trying to feel better. Unfortunately, the happiness from a purchase often fades quickly. The debt does not. As balances grow, something else begins happening. Interest starts working against the borrower. Many Americans underestimate just how expensive credit card interest can become. At first glance, paying only the minimum amount appears responsible. After all, the payment is made on time. The account remains in good standing. There are no late fees. Everything seems under control. But beneath the surface, the mathematics tell a completely different story. A large portion of that payment may be consumed by interest, leaving only a small amount to reduce the original balance. Month after month, progress feels both use the same card. Both receive similar rewards, but over time, one customer costs the bank very little. The other may generate thousands of dollars in interest. That difference explains why the credit card industry has become one of the most profitable sectors in American banking. Most people don't wake up intending to stay in debt. Debt usually begins with good intentions. I'll pay this off after my next paycheck. I'll clear it once I get my tax refund. I'll pay it after my annual bonus. Life, however, rarely follows perfect plans. An unexpected medical bill appears. The rent increases again. A child needs school supplies. The family car suddenly needs a major repair. The balance remains. Interest begins accumulating. The cycle quietly continues. This is where psychology becomes just as important as mathematics. Human beings naturally focus on immediate problems more than future consequences. When someone has no money for groceries today, next year's interest charges don't feel important. Today's emergency wins. Tomorrow's problem can wait. Banks understand this better than almost anyone. That's why credit is designed to feel effortless. Applying takes only minutes. Approval often happens almost instantly. A new card arrives in the mail within days. Borrowing thousands of dollars can sometimes be easier than applying for a library card decades ago. But paying it back is rarely that simple. Many Americans eventually find themselves juggling several credit cards at once. One card has the lowest interest rate, another offers cash back, another was opened during a balance transfer promotion. A fourth exists simply because the previous cards reached their limits. Without noticing, a household can accumulate multiple payments spread across different dates every month. Managing this financial puzzle becomes exhausting. Miss one payment. Late fees appear, interest rates may increase, credit scores begin falling, future loans become more expensive, the financial pressure intensifies. One mistake creates another. The good news is that this story doesn't have to end the same way for everyone. Debt is powerful, but it isn't unbeatable. The families who eventually escape the cycle usually don't do it through luck. They do it by changing the way they think about money. They build emergency savings before buying luxuries. They pay more than the minimum whenever possible. They avoid borrowing for things that lose value. Most importantly, they stop asking, "Can I afford the monthly payment?" and start asking, "Can I truly afford the full cost?" Banks will continue offering credit. Advertisements will continue encouraging people to spend. New payment apps will continue making borrowing feel effortless. Those forces aren't going away. The real question is whether consumers recognize the game before it quietly takes control of their financial future. Because every swipe represents a choice between instant satisfaction and long-term security, a choice between paying interest or earning interest, a choice between living paycheck to paycheck or building lasting financial freedom. America's credit card crisis is about far more than plastic cards or rising balances. It's a reminder that the strongest financial foundation isn't built on borrowing, it's built on discipline, planning, and patience. History has shown that economies recover, markets rise and fall, interest rates change. But the financial habits people develop today can shape the rest of their lives. Perhaps the greatest investment isn't found in the stock market, real estate, or even a retirement account. It's learning how money truly works before debt begins controlling your future. If this video helped you see the hidden side of America's credit card crisis, share it with someone who needs to hear this message. You never know whose financial future it might change. And if you enjoy deep, fact-based documentaries about money, the economy, and personal finance, don't forget to like, subscribe, and turn on notifications, because understanding money may be one of the most valuable skills you'll ever learn.